So let me take this opportunity to welcome you to our today's session. Our class, which we are continuing with today, we are doing the capital structure theories, a subtopic. We remember very well that we were earlier on discussing about the advanced financial decisions, where we did WSCC and WMCC. And now we are doing the capital structure theories before later on doing the special topics in financing. And I remember I said that these are just meant to, the capital structure theories are meant to explain the effect of the debt finance to the value of the firms. And I remember we were able to do the traditional theories where I based my argument on the net income approach. I was also able to do the net operating income approach. I was also able to do Modigliani and Miller propositions, where we have already discussed MM1. That is where we are discussing that the house argue that it does not recognize the existence of the taxes, and therefore we say that when we are discussing about the net income approach, we are just going to be having two companies. We normally have a group of two companies. One, we normally discuss about unlevered farm. These are the companies which operate without debts. We also have levered farms. These are the companies which already operating with debts on their capital structure. And in this case, I remember I had already explained to you about the MM2, where I say that Modigliani and Miller argue that in environment of taxes, the use of debt, the use of the debt finance would increase the value and reduce the WACC of the firm because of the interest tax shields, and it normally lowers the risk of the investor. Those are the things that I was able to do. I gave you some of the formulas when you are dealing with the unlevered farm. How are we supposed to be getting the value? Because already you have to be determining when you have some, when you are having some, when you are dealing with some debts, how am I going to be, when, for example, there is a recognition, of the corporation taxes, how am I going to be getting the value of unlevered farm or the value of equity of unlevered farm? I remember those ones I was able to define, and I will be able to repeat them because I just want to start with our question, which you can be able to see displayed on our screen. This question was tested on, the question was tested on November 2016, question 3. And I just want to start our class from that point, where I just want to rush and see whether I will be able to finish the topic so that we can engage on our last topic of the discussion before the commencement of next week, because I just want to give you some time for revisions and also for allowing us to assess ourselves and look on the areas which need attention. So let me just say this. Majul Limited is just about to commence operations as an international trading company. We are saying that the firm will have a book value of assets of 320 million, and it expects to earn 16% return on these assets before interest and taxes. However, because of certain tax arrangement with foreign governments, the company will not pay any taxes. So it is not that the capitalization rate for an all equity firm in this business is 12%. So the company can borrow debt finance at the rate of 7% per annum. The management is in the process of deciding how to raise the required 10% million debt finance. Assume that we are going to be using the Modigliani assumptions there. We have been told required, number one, using the Modigliani and Miller model without taxes, determine number one, the current value of unlevered farm. Two, we have been told to come up with the current value of the levered farm if it uses a 10%, 10 million, 7% debt. Then number three, we have been told to calculate the WACC of the organization. And in this case, remember here, we are just going to be handling the concept which you are able to learn from MM1. And to be able to sort out this kind of a problem, this is what you normally do. Let me take you back to my, board and see how we're supposed to be sorting the question. I hope you have everything with you, calculator, you have a place to write, so that we can be able to understand the concepts. Let me just also take my calculator. Yes, now I'm ready. Now, let me share my board so that I can provide the solution of the question. Let me share here. I hope things today will not be able to disturb us. So we are doing AFM. So we are doing capital structure theories. We are doing capital structure theories. And in this case, there is a question of November 2016. I think it should be question 3B. November 2016, it should be question number 3B, question 3B. Let me ensure that you can be able to see everything. Just 1 minute. Better. Okay. So let us proceed now and look for this question. We are discussing about November 2016, question 3B. Because number A, we are discussing about the assumptions. So you can do your analysis on your own. So let me focus on number 2. And my camera will just stabilize as we move on. So the part of the question 1, we have been told about to calculate the current value. They have said, under this question, question number A. Is it question number A? Question number B is discussing about the MM1, right? MM1. And we say that in this case, we normally, this model does not recognize the availability of taxes. And I can just be able to remind you, it assumes that taxes do not exist. It normally assumes that the taxes do not exist. Now, from that angle, allow me just to be able to focus on the requirement of the question. Number A, or number 1, we are being asked about unlevered farm. What is the value of unlevered farms? And in this case, I will just be able to repeat our formula, where we said, based on the requirement of the question, the examiner just wants us to get the WSEC, or the value of unlevered farm. And this is what we said. To get the value of unlevered farm, or to get the value of unlevered farms, which is the same as the value of equity of unlevered farm, we normally take earning before interest and taxes. We divide it by earning before interest and taxes. We divide by the cost of equity. That is how we normally get the value of unlevered farm. But the biggest question is per our requirement here. I can see we don't have the earning before interest and taxes. And if it is not provided, I say there is no any problem. If it is not provided, no problem. And in this case, I say, because when you look on where the question starts, let me just go there on the question. The question reads that the firm will have a book value of assets of 320 million, and it expects to earn 16% return on these assets before interest and taxes. So it means already examiners has provided us with earning before interest and taxes. So how am I going to be getting my earning before interest and taxes? I say I'm going to be taking 16% of 320 million, right? 16%, this will be the return. So 16% of 320 million is how much? So 0.16 times 320 million. And I can be able to see we are getting 51.2 million. 51.2 million. That will be our earning before interest and taxes. And because under the unlevered farm, we don't have much to do, can you be able to ask yourself, what is our cost of equity? I will just be able to take you back to our question. And I say, to get the cost of equity, I'm just going to be seeking from the paragraph 2, where we have been told, it is known that the capitalization rate for an all-equity firm in the business is 12%. So it means my cost of equity is equal to 12%. What is the value of this firm? The value of unlevered, which you have said is the value of equity. It is the unlevered form for the new students, it means that these organizations are equity financed. Equity financed. They don't recognize the availability of any source of finance or debt. Now, in this case, it means our earning before interest and taxes, we have 51,200,000. You divide it by 0.12. How much is the value of equity of unlevered farm? So I just take my answer, divide by capitalization rate, which is the same as my capitalization, which is the same as the cost of equity, will be equal to Kenya shillings. We are talking about 426, 666, 667. That is the value of equity of these levered farms. Now, from there, allow me just to focus on the second requirement of the question, in case we don't have any question. What is the second requirement of the question talking about? So this requirement says the current value of the levered farm, if it is going to be using a 10% debt, and in that case, it means if you want to look on the MM1, it means that we said under MM1, the value of the levered farm, or let me say this, the value of a levered farm is the same as the value of the levered farm, because there is no any recognition of debt under MM1. We don't recognize the availability. These organizations are fully financed by equity. So it means if I'm going to be subtracting nothing, there is no interest which is going to be subtracted here, then the answer remains the same. And that is why I'm just equating here. And this means that the value of unlevered farm, which is the same as the value of the levered, we are going to be getting 426, 666, 667. Imagine by doing that, you're just getting 2 marks. By telling the examiner, I'm understanding that you're not going to be bringing any confusion in me. The value of unlevered is the same as the value of the levered under MM1. Now, let me go to part 3 of the question. Part 3 of the question, and I will be able to repeat some concepts. Part 3 of the question, we are being asked about the weighted average cost of capital of a levered farm at a debt level of 7%, 10 million. And I will be able to say this. When you are dealing with these concepts of levered and unlevered farms, we said under MM1, the WSEC of unlevered farm, I'm just repeating it, of unlevered farm should be the same as the cost of equity of unlevered farm, which should be equal to 12%. So if the examiner could have asked you about the WSEC of unlevered farm, we could just be equating and getting our answers 12. But when he's asking us about the WSEC of the levered farm, I just be able to tell you, can you be able to take the weight of equity, cost of equity, plus weight of debt, cost of debt? And in this case, it means to be able to get our weights, we have to be getting the total value of this organization. Am I going to be getting the value of the farms? It means that I'm going to be taking 426 million, 666, because this is to get the value of the levered. Let me just repeat using that concept for better understanding. The value of the levered should be equal to the value of equity. The value of unlevered. Let me check that formula, which I just want to introduce, or I just want to remind you. We said the value of the levered, we normally take the value of equity plus the value of debt. So in this case, it means the value of equity of ours is 426,666,667 plus the value of debt, which is 10 million. And in this aspect, it means I'm going to be getting an answer of 436,666,667. That is what I'm going to be getting. That is what I'm going to be getting in the total value of the farm, the total value of the levered farms. Now, because when you're discussing about a levered farm, it is financed both. All right. These are the companies which are normally financed by both the debt and equity. Now, to get your weights, it means, can you be able to take the value of equity, divide with the total? You will be able to get the weight of equity. And if I need the weight of debt, I will just be able to take 10 million divided by the total. So allow me to do so. So in this case, it means I just take 436 million, 666, 667, divide by the total, is it 426? Divide by the total, which is 436, 666, 667. You multiply by the cost of equity. How much is the cost of equity? And the cost of equity of ours, we are going to be using what? What is the cost of equity? We say examiner has not provided us with the cost of equity. And I said, if the cost of equity is not provided, there is no any problem with that. We can just be able to get it. How do we normally get our cost of equity? I say take your EBIT, subtract your interest, right? Then you divide by what? EBIT, we divide by the value of equity. You divide by the value of equity. In this case, it means you just need to take 51,200,000 minus our interest. What will be our interest? I go back to the question. Our interest will be 7% of 10 million. 7% of 10 million. Then we divide it by 416 million, 666, 667. So how much is this? So in this case, we say 51,200,000 minus 0.07 times 10 million. Right? Then we divide by 416 million, 666, 667. How much am I getting? Let me just repeat again. 51,200.
Is it 416 or 426?
Sorry?
Is it 416 or 426?
Okay, let me see. Let me see. Let me repeat something here. Thank you so much for asking that question. Yeah, there is only one thing which is not here. Which one? Because what we have gotten here, under the additional information number 2, I have seen here, we have said the value of the delivered farm is 426 million. 666, 667. We should be equal to the value of equity is not the one which is available. So the value of equity we don't know, plus the value of debt, which is 10 million. So it means the value of equity of ours should be 426 million, 666, 667 minus 10 million, getting 416. Let us just use the long figures. It should be looking like that. This should be the value of equity because already we have the value of the delivered. I had already forgotten this additional information. Now, after doing so, now we can be able to get our cost of equity, which will be equals to 51,200,000 minus 7% times 10 million divided by 416. That is where the 416 is coming from. 666, 667. How much is this? So in this case, I say 51,200 minus, I just open my brackets, 7% times 7% of 10,000. I mean to use in thousands of shillings. Then we divide this by 416. We divide by 416, 666, 667. We are getting around 0.12 something. This should be translating to around 12.1%. 12.1%. 12.1%. So how much it is? It means, because here we were calculating the WACC of the delivered, so I have taken 420, it should be 416 here. 416 we divide by 426, because the 426 is our total, is the value of the farm. Then we multiply by 12.1 plus 10 million. We divide this by 426, 666, 667. We multiply by 7%. We multiply by 7%. We multiply by 7%. How much is our answer here? How much should be our answer? How much should be our answer? Someone? So in this case, it means if I take 416, 666, 667, I divide this by 426, 666, 777, I'm supposed times 12.1. This one I'm getting 11.82. Plus, the other one will be how much? 10 million. You divide by 426, 666,667 times 7. And this one you put in full, in whole numbers. How much am I getting here? How much are you getting? Getting something closer to this 0.16. Someone with different answer, how much are you getting there? 0.16. Is that the correct answer? Okay. So let me repeat because I have confused. 426, 666, 667 times 7, getting yes 0.16. So what is the total value, or what is our WCC? I say plus 11.82, getting something closer to 12%. Something closer to 12%. Something closer to 12%. 12%. Now, let me look now on the introduction of MM2 under the number C of the question, where we are being told, assuming that the company in B above now pay taxes at the rate of 30%, compute the following in Modigliani and Miller worlds. And in this case, it means the examiner is just asking you about whether you understand the concept of MM2. The MM2, right? The MM2. That is just what the examiner is asking there. How are you going to be computing using MM2? Yeah. Let us continue now. When we are having MM2, we are being told the current value of a firm if it uses no debt. And in this case, it means the examiner is asking you whether you remember the formula we were discussing about the value of a levered firm, which is the same of the value of equity of unlevered, which is we normally take EBIT. But we said MM2 normally recognizes the availability of corporation taxes. That is what we said. So we take EBIT minus interest. We divide it by the cost of equity. We divide it by the cost of equity. We divide it by the cost of equity. And in this case, it means we have to be looking on our EBIT, which is 51,200,000 minus 51,200,000. What are we subtracting there? We say, can we be able to subtract our interest? Is it our interest? It should be taxes, sorry. It should be taxes because we are recognizing the availability of taxes. So in this case, it means I'm just going to be subtracting 1 minus 0.3, right? 1 minus 0.3 is how much? It is the net of tax, right? I'm giving you the wrong formula, sorry. Let me now give you here. This is what it should be. It should be EBIT 1 minus 0.3 or 1 minus taxes. May not give you the wrong figures. Now, here we take 1 minus 0.3. We are not subtracting the interest. We divide by the cost of equity, which is 0.12. How much is this, Frida? Is it Frida or Farida? How much is that? How much is that? How much is our answer? Nobody the answer. No one is having an answer. Who is this now? You want me to see her? Okay. Yeah. Let me just do it for you. Let me do it for you. Sorry for that. So my answer should be 51,200,000 times 0.7 divided by 0.12. I can see we are getting Kenya shillings. 298 million 666 667. That is what we are getting as the value of equity of unlevered farm, which is the same as the value of unlevered farm. That is how we normally compute it. Then from there, the second requirement we are being told, the current value, we are being told the current value of the farm, if it uses the debt level of 7%, 10 million, right? And we said, because here we have, this was number one. Number two, we are discussing about the levered farms. Correct. And I remember here we said, to calculate the value of levered farm, we are going to be taking the value of levered farms, we are going to be taking the value of equity plus the value of debt, then you multiply by the tax rates. I remember under our previous video, we have something closer to that. And in this case, we ask ourselves, how much will be our answer? The value of equity, we have it, right? What is our value of equity? Do we have the value of equity? And we say we have it. How much is it? We say the value of equity here will be 298, 666, 667. We add the value of debt, which is 10 million times tax rate of 0.3. Tax rate of 0.3. Tax rate of 0.3. How much are we getting again? How much are we getting there? How much are we getting there? This should be the value of unlevered. The value of unlevered, that is why I'm just taking it directly. I was just separating you from the concept of this one, whereby the student would now be asking mwalimu, mbona hapa ulitoa ukasema the value of the levered. So we normally take the value of unlevered, which is 298, 666, 667. Then we add the value of debt times tax rate. So let us start with the tax rate, 10 million times 0.3. Then we add it to 298 million, 666, 667. I'm getting something closer to 301 million in shillings. 301 million, right? 666, 667. That is how you're getting the value of the levered farm. The value of the levered farm. That is how you're getting it. Then we have number 3. We have number 3, where the examiner is asking you now, because we are using MM2, can you be able to calculate for us WSEC? Because we are using MM2, is it possible to understand how to calculate the WSEC of the levered farm? And you say there is no any problem of computing the WSEC of the levered farm. Why? Because to get this WSEC, to get the WSEC of the levered, we said, to get the WSEC of the levered, we said that we are going to be taking the weight of equity, cost of equity, plus weight of debt, cost of debt. Then we adjust for taxes. Then you adjust for taxes. And I said very, very well that the examiner might just be denying you a very simple concept here. What is the examiner might be denying me? The examiner might be denying you the cost of equity of the levered farm. I ask you, how do you normally get the cost of equity of the levered farm? I say, to get the cost of equity of the levered farm, we normally take the cost of equity of unlevered, plus we normally add what? We put in the brackets, the cost of equity of unlevered farm minus the cost of debt. Then we take the ratio of debt to equity. Then we adjust for taxes. We adjust for taxes. 1 minus T. Now, what is the cost of equity of unlevered farm? And I say, the cost of equity of unlevered farm, we know very well, is 12. That is what we were given. Then here, we take the cost of equity of unlevered farm, we have 12, minus the cost of debt, which is 7. The debt to equity, we know very well. Our value of debt is 10 million. We divide it by the value of equity. The value of equity is also not provided. We say, to get the value of a levered farm, we say, take the value of equity plus the value of debt. What is the value of the levered? Is this one. We were able to get 301 million, 666, 667, right? We should be equal to the value of equity plus the value of debt, which is 10 million now. So it means the value of equity of the levered should be 291,666,667. So that is what we are using here. 291,666,667. Then we adjust for 1 minus 0.3. That is what we require. And in this case, we use BODMAS. We use BODMAS. Allow me just to start with this division. So it will be 10 million. We divide by 291,666,667 times 0.7 times the difference here, we are getting 5 plus 12, getting something closer to 12 points. This should be 12.12%. That is what we are getting at the cost of equity of the levered farm. The cost of debt, we know, we have it. How much do we have it? We say the cost of debt, we have 7%. So in this case, it is very easy for me to compute the WCC of the levered. I say the weight of equity, I can just be able to get it by taking what? I can be able to get, because this is a levered farm, don't confuse it with unlevered farms. We say we take the value of the levered, of equity of the levered, which we have gotten 291,666,667. We divide it by the value, right? The total value of this organization, the total value of the levered farm, which is 301,666,667, times the cost. The cost of equity we have gotten is 12.12. Plus the weight of debt, we say we are taking 10 million, we divide by the total, which is 301,666,667 times 7. Then you adjust for taxes, 1 minus 0.3, as per our formula up there. As per our formula up there. So how am I going to be getting my answer? So let me start from the side of equity. I say 291,666,667 divide by 301,666,667 multiplied by 12.12, get 11.72 plus the other one we are discussing about 10 million, divide by 301,666,667 times 7 times 0.7. Okay, we're getting 0.16. So how much is our answer? 11.72. Getting around 11.88%. 11.88%. By doing that, you will be in a good books. You'll be in a good books because you'll be already in a position to overcome the challenge. Now, what is our conclusion here? If the examiner was asking us to table our conclusion, because already you are dealing with two farms, what is your conclusion at the end of the day? We say debt is always, because when you look at it, the weighted average cost of capital of a levered farm is 11.88 compared to the 12% where we were able to do for the unlevered farm. And in this conclusion of yours, we are supposed to say the debt increases the value of the farm. Debt always increases or always increase the value of the farm and reduces the WCC. And reduces its WCC. It reduces its WCC. Hence, under MM2, capital structure decisions, capital structure, financing decisions, financial decisions are relevant. Allow just me to write up to that point. The financial decision, the capital structure, financial decisions are relevant. That is how you normally, if the examiner was asking you to write on conclusions, that is what you should have provided. That is what you should have provided. I would request you to allow me to do another illustration. Allow me to do another illustration. Let me see the best one so that I can also give you some assignments. I can give you some assignment there. Okay, so let me do a question tested on May 2019 question 4B. May 2019 question 4B. May 2019. May 2019, unless there is a question. There is another student I normally teach, and then when you are finishing the class, now he asks where we started. Even the question becomes hard to answer. Now, let us look on November or May, sorry, May 2019. Question 4B. May 2019, question number 4B. Let us go there. May 2019. What is there? 4B. Cecilia, can you read for us quickly? Kindly.
Okay. Ziani Limited, an unlevered farmers in issue 10 million ordinary shares that are currently selling at the Securities Exchange for 20 shillings each. Additional information. 1. The firm's most recent earnings per share is 4 shillings and adopts a 100% dividend payout. 2. It is expected that the firm's future dividends in each year will remain constant in perpetuity. 3. The firm is considering to issue 12% new debentures to raise 50 million shillings in order to finance an expansion program. This will effectively change the status of the firm from unlevered to a levered firm. 4. The firm pays corporation tax at the rate of 30% required. Using M&M propositions, determine 1. The cost of equity before and after issue of the long-term debt. 2. The weighted average cost of capital before and after issue of the debt. 3. The current market value of the firm before and after issue of the debt. 4. Advise the management of Ziani Limited on whether to change its capital structure.
One of the things which I have not seen in the question, thank you, is that we have not been given with we are not provided with the profit after tax. The profit after tax is not provided. Or I should be talking about earning before interest and taxes. It's not provided in the question. And but the examiner has given us a good 2 points here. 1, when you look on additional information number 1, the examiner says that the firm's most recent earnings per share is 4 shillings, right? And we are being told it is going to be adopting 100% dividend payout, right? So there is no any retention here. And we are being told very well that this company is able to issue 10 million ordinary shares. In that essence, it means we are being provided with a very simple concepts, right? What are the simple concepts? Let's look at for them. Let me share my solution here with you. Let me provide you with a solution. Let me say, for the solution which I'm going to be providing for this question is very simple. That To get our profit after taxes, I need to take earning per share. I multiply by the number of ordinary shares. And in this case, we are being given the earning per share is 4 shillings times the number of ordinary shares, which we are being given as 10 million, which we get Kenya shillings 40 million, correct? Number two, you have to be asking yourself, because if I can be able to write this formula here with you, if we can be able to write this formula, I will say, to get for example, to get before debt, because that is the question number one, before debt. It means we are dealing with unlevered farms. Before debt, we deal with unlevered farms. And we say, to get the cost of equity of unlevered farm, here we apply MM2. To get the cost of equity of unlevered, we are going to be taking earning before interest and taxes. We adjust for taxes. Then we divide by, what are we going to be dividing with? We divide by the value of equity of unlevered farm. The value of equity of unlevered farm. The simplest question will be, how am I going now, under my circumstance, to get the value of equity of unlevered? I will say, take the market price per share, multiply them with the number of ordinary shares. Multiply them with the number of ordinary shares, right? That is another way of getting the value of equity of unlevered farm. The market price per share, we are being given in the question. What is the question talks about? We are being told, before the additional information, that the unlimited and unlevered farm has in issue 10 million ordinary shares that are currently selling at a securities exchange of 20 shillings each. So in this case, it means it is 20 times 10 million, translating to Kenya shillings, 200 million. So to get the cost of equity of unlevered, it means I'm going to be taking my earning before interest and taxes, which is 20 million, right? Let me talk about the 20 million. Is it 20 or 40? We discussed about 40 million, right? 40 million. Then we are also talking about, look on the cost of equity using the Modigliani determine one. We are being asked about the cost of, so in this case it is 40 million, adjust for taxes, then we divide by the value of equity of unlevered, which is 200 million. How much are you getting here? What is your answer here? Be able to say 40 times 0.7 divided by 200. We should be getting something closer to 14%. Are we getting 14%? Are we getting 14%?
Yes.
Now, the second one will be, because we have been told, the cost of equity before and after the issue of the long-term debts. Now, let us talk about after debts. What will be the after debts? I say very well that to get of the cost of equity of the levered, take the cost of equity of unlevered plus the cost of equity of unlevered minus the cost of debts. Let us compute equity to debts. Then we adjust for taxes. Correct? Correct. Now, in that aspect, it means we might just be missing something here. And that something might be the value of equity, because we might be having the value of debt. Now, in this case, all we can be able to determine, there is no any problem with that. So we have just first to be looking for the two, because they might not be provided in the question. And in this case, I will be able to say, when we are using the, for MM2, for the levered farms, we say, to get the value of the levered, we normally take the value of unlevered plus the value of debts, we multiply by tax rates. Multiply by the tax rates. What will be the value of unlevered farm? We say the value of unlevered farm of ours, the value of unlevered, we have said is 200 million, right? We add, what is the value of debts? What is the value of debts? in note number 3, additional information, we are being told the firm is considering to issue 12% new debentures to raise 50 million in order to finance an expansion program. So it means here we are using 50 million times 0.3. So how much is this? How much is that? So 50 million times 0.3 plus 200 million. We are getting something closer to 215 million. 215 million. 215 million. From that analysis of getting 215, you can also be able to ask yourself, what is the value of debt? What is the value of debt or equity? What is the value of equity? They'll be able to put a very simple formula here. We say, to get the value of a levered firm, we said, take the value of equity plus the value of debt, because it's normally financed by both. Now, in this case, because we have used this formula, I just want to determine how much is our equity. So in this case, it means by taking 215 million, we are going to be equating it to value of equity plus the value of debt, which is 50 million. The value of debt, which is 50 million. How much is the value of equity here? It means I take 215 million minus 50 million, getting something closer to 165 million. Therefore, to get the cost of equity of the levered, I'm going to be taking the cost of equity of unlevered. How much was it? The cost of equity of unlevered, examiner is giving how much? The cost of equity. The cost of equity of unlevered. We were able to get something here. How much was it? It was around 14%. So it will be 14. We add the cost of equity, which is 14, minus, what is the value of debt? The value of debt, which is 12. The value of debt, which is 12. Let us take equity to debt, and our equity we have seen is around 165. You divide by how much is our debt? The value of debt, right? It is debt to equity or equity to debt. This should be debt to equity, sorry. Here, this should be debt to equity. Debt to equity. Is it like that? Yes, it should be debt to equity. So how much is our debt? Our debt is 50. That is why I have seen it looking awkward. 1 minus 0.3. So let me start by taking 50. Divide by 165 times 0.7 times 2. Right? So here we are getting something closer to 0.42 plus 14, getting around 14.42%. 14.42%. Then number 3, we are being asked about the weighted average cost of capital before and after. And in this case, I say to get the weighted average cost of capital before debt. The weighted average cost of capital of unlevered, we said it is the same as the cost of equity of unlevered, which we were able to get around 14%. That is already done. Then we talk about the WACC of the levered, which is said, just take the weight of equity, cost of equity, plus weight of debt, cost of debt, adjust for taxes. We adjust for taxes. How much is the weight of equity? And I say very well, to get the weight of equity, because already we have the totals. The totals for them is here. The total of the firm is 215. You have the value of equity, and then you have the value of debt. It is very simple here. We say this. The weight of equity, we are going to be taking the value of equity, 165 divided by the total, which is 215, times the cost of equity. How much was the cost of equity? And I say the cost of equity here, we are going to be using how much? We are going to be using the one that we have gotten somewhere. 14.42. The weight of debt, I take 50 million, divide by 215, times the cost of debt is around, we are being given as 12. Then you adjust for 1 minus 0.3. So what will be our answer here? So let me start with the side of equity, right? Times 14.42. Here get 11.07 plus 50 divided by 215 times 12 times 0.7. No, will not be able to get a good answer. Getting around 1.95. Or let me talk about 2. This will be around 13.07%. 13.07%. 13.07%. And in this case here, we say that part 3 of the question, because we have done only part 1 and 2, part 3 of the question, what is the value of the farm before debt and after debt? Right? And this question is that the examiner is just giving you the free marks. The before debt and after. He said, to get the value of unlevered before debt, it is not going to be changing anything. So before debt, it will be looking like this. The value of the farm before debt. So how will it be looking before debt? Unakuja tu hapo unaambia examiner, I know what I'm doing. So to get the value of unlevered farm, which is the same as the value of equity of unlevered farm, we should be getting 200 million. I think that one we were able to get it somewhere, and you know where it was coming from. Then after that we have it. Right? The value of the levered, we have it here. Right? Which we were able to get it straight away. Unakuja tu unamwandikia 215 million. 215 million Kenya shillings. So you're not doing it. Then the last one, we are being taught to advise the management of the unlimited on whether to change its capital structure. We say, change your capital structure, yes, since it is going to be increasing the value of the farm. Without the debt, we have 200 million. With the debt, we have 250 million. But we are saying that it is going to be changing the value of the farm from 200 to 215, and it is going to be reducing the costs of the farm, the WSCC values. You can see here, after the debt, we are getting 13.07. Before debt, it was 14%, therefore reducing the value, reducing the WSCC. That is what we have said. Let me give you an assignment. How much will be our assignment? We say this will be May 2018. Question number 4B. May 2018, question number 4B. You can just go and try. Just go and try your level best and see whether you can be able to understand that concept. I just want to introduce you to the last 2 concepts for Modigliani. The Modigliani and Miller propositions. We were discussing about 2 things here. We were discussing about, we have already done MM1 and MM2. So allow me to do MM3 and MM4. Very simple things here. Hapa tu ni kushika formulas, nothing different. So let us look on MM3. MM3, and we say under MM3, this one normally recognize the following. It normally recognize the availability of cooperation and personal taxes. The corporation and personal taxes, and we say unlevered farms will be affected by corporation taxes, and and personal tax. We talk about the personal tax on stock, which is normally written as TS, personal tax on stocks, while a levered farm, will also be affected by personal taxes on debts, right? On the personal taxes on debts, CD. So it means when I'm going to be calculating for unlevered farms, and I'm going to be calculating the value of unlevered farm, which is the same as the value of equity of unlevered farm, we are supposed to be taking earning before interest and taxes, and just for taxes. Then we are going also to be adjusting for, we have said it is normally affected by the corporation tax and also the personal tax on stock. That is what we have adjusted here. Then you divide it by the cost of equity of unlevered. The cost of equity of unlevered. But when we are dealing with the levered farms, allow me just to write it here. The value of the levered farms, we say, to get the value of the levered farm, we are going to be taking the value of our levered farm plus the tax shield on the total debt. The tax shield on the total debt. And I say, to get the tax shield on the total debt, what am I going to be doing here? I say, take the value of debt, adjust it for, take a big one, minus, take this in brackets, corporation tax of 1 minus T, then we have personal taxes here. Then we divide this by, correct, 1 minus TD. Something looking like that. So it means to get the value of the levered will be equal to the value of unlevered plus the value of debt. Then you put in bracket 1 minus 1 minus T, 1 minus TS, total tax, personal taxes on stock, divided by 1 minus TD. That is what you need to know about MM3. That is all about MM3. Let us do MM4. Before we do an illustration, we go to MM4. And I say, we normally recognize the availability of corporation taxes. We normally talk about the corporation taxes and financial distress costs. And financial distress cost. And we say a levered farm will be affected by financial distress costs. Financial distress costs due to the risks associated with the use of debt finance. Risk associated with the use of debt finance. This cost arises in form of bankruptcy. Normally arise due to bankruptcy and urgency. Normally arises due to the following, the two. Now, in simple terms, we say MM4 is an extension of MM2. It is an extension of MM2. It is an extension of MM2. So let us look on what does that mean. Just want to do two quick. Let me talk about one quick question. Then I give an assignment. One quick question, I give you an assignment. One quick question, I provide an assignment because I just want to complete the topic so that we can complete our classes on Friday, before Friday. Okay. Is it possible? Yes. I will not be able. I must touch somewhere. We can complete on Friday. Now, let me just do a question here. Sorry, let me provide you with the formulas for MM4. Let me provide the formulas for MM4. We start with which one? Which formula do we start with? I say, let me start with the formulas for the levered farm, unlevered farms. Which is the formula do we have for the unlevered farms under MM4? Because already we have said it's an extension of MM2. We say to get the value of unlevered farm, which is the same as the value of the equity of unlevered farm, we normally get earning before interest and taxes. We adjust for our taxes. Then we divide this by the cost of equity of unlevered farm. The cost of equity of unlevered farm. And if you need to get the cost of equity, you just need to cross multiply there. What about the levered farms? And this is why we are saying the MM4 is just an extension of MM2. To get the value of the levered farm, we normally take the value of unlevered plus the value of debts times tax rates. Right? Times tax rates minus the present value of the financial future financial distress costs. The present value of the financial the future financial distress costs. This is what we are calling the present value of the future financial distress costs. Of the future financial distress cost. That is what it means. That is what it means. Allow me just to do one question. I give you and then the other one for revision. There is a question in May 2021. You're supposed to be looking on these past papers and you see common questions. May 2021, question 3B. May 2021, question 3B. Who is ready for us? Let me see. It's a long time to hear from Beatrice. Good evening. Hi, Beatrice.
Good evening.
How are you?
I'm good.
Thank you. Welcome.
Thank you.
So you're reading for us the 2021 question. May 2021 question 3B. Let's go on.
Bamboo Limited is currently an uncovered farm. The farm is expected to generate a constant operating profit of 20 million shillings per annum in perpetuity. The farm's current market value is 80 million. The management is considering undertaking an expansion activity by use of debt financing. The farm's financial analysts have estimated that the present value of any future financial distress cost is 8 million shillings. However, the probability of distress will increase with leverage according to the following schedule: value of debt, probability of financial distress, pre-tax cost of debt. The corporation tax rate applicable is 30%. Required, the fancy required, the current cost of equity and weighted average cost of capital of the firm. The second requirement, using the pure Modigliani and Miller with tax model, determine the optimal level of debt. Third requirement, evaluate the firm's optimal capital structure when financial distress costs are included.
Thank you so much. You can see the question is giving you 14 marks, but a very small analysis which you have to be doing. And these questions are asking you to understand these concepts of the Modigliani and Miller propositions. So what am I supposed to be doing under this circumstance? Let me just share my solution with you. Let me share the solutions. Let me share my solution with you. Now, in this case, we are being told the first question. What is our first requirement? The examiner is asking us the current cost of equity. And I remember he told you, if the examiner is asking you the cost of equity of an unlevered firm, it means you're just going to be taking the earning before interest and taxes. One, you adjust for tax, then you divide by the value of equity of an unlevered firm. Now, in that regard, when you go back to the question here, you'll be able to find that we have been told the firm is expected to generate a constant operating profit of 20 million. So in this case, it means I just need to take 20 million, 1 minus 0.3, you divide by, what is the value of equity of an unlevered firm? Let me just continue. See, we have been told the firm's current market value is 80 million. You don't even need to calculate now, because the examiners provided them for you. Now, how much it is? Just say 20 million, I multiply by 0.7, divided by 80 million. We are getting around 17.5%. 17.5%. And in this circumstance, if the examiner was asking me to calculate the WCC of unlevered, I just say it is the same as the cost of equity of unlevered, which is the 17.5%. That does not have any stress. I know that up to that point, you have the concept with you. Now, part 2, we are being told, even it is asked there. Now, using the pure Modigliani and Miller proposition with tax model, determine the optimal level of debt. And in this case, it's very simple because examiner is asking me to calculate the value of the levered firm, where we'll be able to take the value of a levered firm plus the value of debt, and then I multiply by the tax rate. Correct. Then it means there we are not including anything as per the requirements, right? Because we have been told use the pure Modigliani and Miller with tax model, determine the optimal level of debt. Now, in this case, allow me just to determine the values by taking what? What is being provided in the question up there? It is the value of debt, right? So, in this regard, to get the value of the firms, what am I supposed to be doing? I'm supposed to be saying this. This is what I'm supposed to be doing. I'm supposed to be taking the value of debt. Yeah? The value of debt, right? So already you are being provided by the examiner in millions of shillings. So the first one will be 2.5. We have 5. We have 7.5. We have 10, right? 12.5. 12.5, 15, we have 20. Then we have, let us look on the value of these, the value of unlevered. The examiner has already provided you with 80 million. So to apply the formula is very simple. To get the value of the levered here, I just need to take the value of unlevered, it will be 80. Let me just write all through. 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Okay. But the value of debts, how much is the debts is provided by the examiner there. I can see the first one, debts, pre-tax cost of debt. Sorry, the value of debts are the one which I've written here. So the first one is 2.5. The second one, 5, 7.5, 10, 12.5, 15, and then we have 20. We multiply by the tax rate as provided there. The tax rate we have 0.3, 0.3, 0. You can see how simple it is. 0.3, 0.3, 0.3. So how much is our answers here? So the first one will be 2.5 times 0.3 plus 80, getting 80.75. The other one will be 80 plus 5 times 0.3, getting 81.5. The other one will be 80 plus 7.5 times 0.3. We are getting 82.25. 80 plus 10 times 0.3, getting 83. The other one will be 80 plus 12.5 times 0.3, getting around 83.75. The other one we are being asked about 80 plus 15 times 0.3. I think we are getting 84.5. And the last one will be 80 plus 20 times 0.3, getting 86. So as per the requirement here, we were being asked about to determine the optimal debt level. From the analysis that you have done there, what is your optimal debt level? What is the optimal debt level? You can see the one which is providing us with the more the value, right? The more the value of the farm. How much is the value of the farm? We say the last one. So the optimal debt level is 20 million. The one that is giving you the highest value of the farm, which is 86 million, Let us go to number 3. Number 3 now. And the examiner is asking, evaluate the farm's optimal capital structure when the financial distress costs are included. The financial distress costs, I was able to see them somewhere. We were being told the fund's financial analysts have estimated that the present value of any future financial distress cost is 8 million, and then the probabilities are provided there. So what am I supposed to be doing? It means the formula applicable there is the value of the levered. We said the value of levered plus the value of debt times tax rates minus the present value of F distress costs. Now, in this case, what I'm seeing here, the value of all of this we have already done, right? So I just need to copy the answers here. 80.75, 81.5. We have 82.25, 83, 83.75. We have 84.5. We have 86. Then we subtract the distress, the present value. We are getting the present value by multiplying the probabilities. How much is the distress? You are being given in the information as 8. Multiply with those probabilities provided there. So the first probability I can see is 0, 0, right? It is 0, 0. The second one should be 0.0125. The third one, you convert that to decimals. The third one should be 0.025. The other one will be 0.0625. Go there in percentage. The other one is 0.125. Then we have 0.3125. Then the last one should be 0.75. How much is this? The first one should be 80.75. The second one should be 8 times 0.0125. Then we take 81.5 minus my answer. I think we should be getting 81.4. 8 times 0.025. Then we take, this should be 82.05. Then the other one will be 83 minus 8 times 0.0625. Getting 82.5. We have 83.75 minus 8 times 0.125, 82.75. The other one will be 84.5 minus 8 times 0.3125. We're getting 82. Then the last one will be 86 minus 8 times 0.75. Getting 80. Getting 80. And then the examiner is asking you a very simple question again. What is the optimal capital structure? And in this case, because he is asking, evaluate the firm's optimal capital structure when the financial distress costs are included. And you can see the one that is providing you with the highest value of the levered firms is 82.75. When you come up to the end here, because here we have 2.5, here we have 5, 7.5, we have 10. This is the 12.5. 12.5, sorry. We have something like 15 and 20. So which one is providing us with the highest debt level? And you can see the optimal debt level here. Optimal debt level is 12.5 million, right? But that does not answer the question, because we are being taught to evaluate the firm's optimal capital structure. And the firm's capital structure will be, how much is our equity? How much is our equity here? Our equity will be, remember this is the value of the firm, should be 82.75, which is the total, minus the value of the debt, which is 12.5, should be giving you the equity value. What is the equity? How much is the equity? Because the firms is based on the debt and equity. Debt, equity, debt, equity. So here we see so how much is this? 82.75 minus 12.5, getting around 70.25. This is the value of equity. This is the optimal, the value of debts. Umeshajibu your examiner. You don't need to struggle much beyond that. So what is the assignment? We say you can do 2 assignments here. May 2019 question 1. Let me just give one. May 2019 question number 1. May 2019 question 1. May 2019, we have question number 1. Now, I just want to reach at that point and see you tomorrow. I just want you to digest what we have done there, so that tomorrow I can be able to do the special topics in financing, and then I compare, or I can be able to combine them with the introduction part of the international financial derivatives, right? So allow me just to stop at that point. Then we meet tomorrow. We see whether we can be able to complete the topic. It is not as short as you can see it. And then on Friday, if possible, let me not guarantee you 100%, due to some commitment somewhere. So if we cannot be able to meet, it means that we have to be sacrificing on over the weekend. We see on Sunday whether we can be having 2 classes on something. I don't want to approach a new week with a task to be done in regards to our syllabus. Is that in order? Is that okay? Let me hear from Irene. Is that okay?
Yes, it is.
Okay, let me stop at that point, allow you to rest again and prepare for a new day tomorrow. And then we shall catch up. I'll be able to upload this video once it's converted. Thank you and good night.